Hey, good morning, options traders, and happy Friday once again. Well, I thought this would be a really good topic to bring up to the group because I know we have a lot of traders that like to write options, and especially the naked options, which I never recommend, but there are still people who do. And for those people who do, they often like to write the index options because they believe that they're less risky. And they say, well, the idea is that indexes typically don't move as much as an individual stock, and so therefore there's less risk. Well, is that really true? Are index options really less risky? Well, to answer the question, we have to first talk a little bit about leverage. So recall that leverage is, or at least one way to explain it, is that it's the percentage increase in an option's price for a given percentage increase in the underlying. So let's say that the stock rises 10%, but this particular option that you have rises 50%. or 5 times that. We would say that the leverage is 5 times or 5x. Or in other words, in percentage terms, would be 400%. So it's just a way of showing how much more sensitive the option's price is relative to the underlying. So just recall that leverage is always the biggest risk when you're writing the options, not whether the underlying can move by a certain percentage or not. We have to look at this relationship between how much is a given change in the underlying going to affect those options. So for the indexes, recall that yes, it's true the indexes are made up of many stocks. And yes, that means it is harder for indexes to move a given percentage than for individual stocks. So the basic idea is that imagine that an index goes up 10%. Well, it would be really hard to imagine that every single stock in that index went up exactly 10%. Instead, what's going to happen is you will see some stocks that will go up a lot more, some might actually go down. And so in order for that index to move 10%, you absolutely must have some stocks that move a lot more. So yes, individual stocks do have the ability to move more than the actual index. But it's this reason why traders think that the indexes must be safer. So, to do an example, let's take a look at the S&P 500 index, the SPX, currently trading at about 43.87, and I'm going to compare that to Apple, currently trading at about 145. So, looking at these two underlyings here, which one do you think has the options that are more expensive? That's your first question. And the second, which ones do you think have more leverage? So jot down your answer, and now let's go have a look. Now we're into the E-Trade platform, and I'm going to start with Apple. And like I mentioned, that it closed at about 145, so just for round numbers, I'm going to call it 145. I'm going to pick the October expirations. No particular reason. We would get similar answers regardless of the expiration. And October right now happens to have about 74 days. So let's compare the at-the-monies. So for Apple would be the 145 strike, and the mark, which again is the halfway point between the bid and the ask, is 635. So it's going to cost you about 635 to buy this option. So how expensive is this? Well, it's all relative. Let's take 635 divided by 145, and that is about 4.5%. So you're having to pay 4.5% of the underlying to control the at-the-money option. Now let's look at a second calculation. Let's say that Apple goes up 10%, which means it's going to go from 145 to about 159. So if we subtract out the 145 strike, that means we would have $14 of intrinsic value. So 14 divided by our 635 purchase price would give us about 2.28, roughly about 2.3 times on our money, or 128% increase. Okay, so now we've got our numbers for Apple. Let's go compare them to the S&P 500. So the S&P 500 is about 43.87, as I mentioned. We do have the Octobers, 74 days to expiration. Now these are trading 10 points wide, at least beyond 43.80. So the closest to the at-the-money would be the 43.90s. So the mid for these options is 119.85. Look at the price of those. And so this is another reason why traders say, oh, I would much rather prefer to buy options on Apple, because every time the stock rises a buck, it's a much bigger percentage change. You really can't make any money on the indexes. And so they flip that logic around and say, therefore, the indexes are much safer to sell. Well, again, let's compare the leverage. So first off, how much are we paying for this option? Well, let's just call it 120. And if we divide that by 43.87, that's 2.7%. It's actually about half the value of Apple. Recall over here that Apple was about 4.5%. So that often comes as a surprise to traders. But now let's look what happens if the index rises a given percent. So let's say 10%. That means it would go to about 48.25. And if we subtract out the 43.90 strike price, that would give us $435 of intrinsic value. So 435 divided by the 120 purchase price is 3.6 times, or about 260%. So look over here for Apple, it was only 128%. So see, we have a lot more leverage in the S&P 500, and this will almost always be true, unless you get some ridiculous amounts of implied volatility, but it's almost always going to be true for your indexes relative to individual stocks. And so this is why you have to be really careful about writing index options, especially if you're doing them uncovered, even though they may appear to be safer. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. You can find it all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.